Welcome to episode 2 of the Mispriced Assets podcast. My guest today is Aznaur Midov, who writes Debt Serious on Substack, a fellow Substacker who's spent his entire career in leverage loans and now private credit. He has a particular expertise in lending to software companies and has a purview into the assumptions that happened when software was eating the world and to today. Because he has a differentiated view in private credit, it leads to an amazing conversation. I hope you watch the whole thing and subscribe and like so that I can get interesting guests on like this, potentially Jim Grant, potentially Thomas Gober, as he has spoken to on his Substack. His Substack is followed by asset allocators, particularly in the credit markets. It is super undervalued. Give him a follow. You're going to enjoy this. Let's go. Okay, Aznaur, welcome on. He is the author of Debt Serious, and he's an expert in private credit, as I've become, to the best of my ability, an expert on private credit. We have some differing views. We're not actually that far apart, but inside of the differences, I think really changed the outcome. So I think it'll be a very interesting conversation for everyone. Welcome, Aznaur.
Thanks for having me.
Calling in from Georgia.
Calling from Tbilisi, Georgia. Yeah.
Not Atlanta, Georgia. So I've been following your work, and honestly, you talked to Gober before me. So you've really been on this. You have an experience in leveraged finance, used to live in San Francisco, and have seen some of, especially when it comes to software, the development of this asset class. You've also done some work on insurance, but your bread and butter really is private credit.
Fair enough. Yeah.
Can you just go through your career history? And what I love to hear is little turning points in the understanding of what's happening and where the opportunity is and where the risk is, whether it's 2021 and you're seeing, oh, wow, everyone wants to allocate to this. So any sort of little nuances and personal experience, I'm always very interested in.
Sure. So after graduating from San Francisco State, I joined Wells Fargo Technology and Venture Banking Group. So I was working with venture-backed startups. Then I did it for a few years, then did some TMT at Wells Fargo, and also did the traditional CNI, like real estate, a little bit of that, all within Wells Fargo. After that, I joined PNC Technology Finance, and what I did there is it's sort of sponsor finance slash leverage lending. We'll basically finance LBOs of software companies, and I did this for most of my career. So I started as a, let's call it, portfolio manager, where I have a portfolio of say 10, 12 names, and I monitor them, I underwrite them, and I work with the sponsor. Then I became the team lead, where when I have a team of portfolio managers, when my entire portfolio maybe 30, 40 names, and half of that portfolio was basically unitranche deals with private credit guys. So for those who don't know, unitranche is traditional sense is basically, let's say, bank PNC was the first out, it's called, um, and private credit would be the last out, which is basically seniority of the loan. And because of that experience, where you basically sit on the same side with private credit guys across the table from PEs, that's where I kind of learned all these dynamics, and where you actually realize that there is not that big of a difference between, say, middle market private credit and middle market lending. And then if you know the history, it's basically that's how it's all started, right? Because after GFC, banks were not allowed to, not allowed, it was very expensive for them to lend to leveraged middle market companies. That's where private credit guys stepped in. And as a result, you can see like the approach to lending is very, very similar. So that's basically the background. in terms of what I've observed over the years, it's like when I just started at PNC, it's the multiples is like leverage how much more aggressive this space became. Because I remember when I just joined, the multiples for SaaS companies were like 6, 7 or something like that for acquisition, right? Banks would lend 1.5 times ARR. Um, First, last out, all these private credit guys would lend 2, 2.5 sometimes for the better deals. Then you went through COVID, and suddenly everything changed on mostly on the acquisition side. The multiples for acquisitions went to 10, 11. You know, public companies. Remember, Zoom was trading at, I think it was close to 50 times ARR, something ridiculous, right? To my surprise, I'll tell you this: that lending side hasn't adapted to this insane leverage. So, like, if we were at 1.5 times as a bank, we didn't double our leverage. We just did more 1.5 time deals. Private credit guys didn't go from two to like 4 or 5. It was 2, 2.5. Maybe they start touching 3 sometimes for better deals. On the upper side, like when Medallias of this world come in, right there you got a little more aggressive. You saw, I think Medallia was levered 4 times, and that back and then it's like you would kind of be surprised that they do this type of deals. But if you saw who was back in Medallia, it's Toma Bravo, right? And they willing to pay what 12 times whatever, you would think, well, Toma knows what they're doing. And before you lose your money on the debt side, Toma has to lose significant amount, and he's like, that's the likelihood of that happening is very slim. Well, then 2022, 2023 came when the uh, interest rate was jacked, and suddenly valuation dropped, and people were like, oh shit, I guess uh, there were like miscalculations, right? One interesting thing I think about COVID as it comes to um, SaaS companies, and it kind of threw a curveball at many people. So the thesis behind this SaaS lending in general is you have very sticky recurrent revenue, the top line, right? That's why everybody's focused on that. And the idea is eventually when you penetrated the market and you no longer grow in 30%, you will cut your expenses, you'll cut your sales and marketing, and your bottom line would come up. That's a thesis. And it makes sense in theory. When COVID came, that was actually tested and it became reality. Like we saw how because of backlog, the top line still held because nobody could travel, sales and marketing was cut, and suddenly we saw that big inflow of cash and EBITDA improvement. And I think to many people it was like signal that their thesis actually holds. But what's kind of different in my view is because of quick reversal, right? Because COVID, that confusion with what's happening in the market didn't last too long, and suddenly people doubled down on sales and marketing and everything, and uh, top line continue growing even more aggressively. So we thought this, how do I say? We thought the thesis was confirmed. In reality, it was just misleading because in 2022, 2023, what we notice is like, well, if things don't go back to normal very quickly, right? Top line stops growing as aggressively. Suddenly, you need to spend more to continue at the same trajectory, and sales and marketing continue burning your cash. It was kind of interesting dynamics. I guess this is the most kind of fascinating part to me about this whole COVID thing.
So that's extremely interesting because you have a confirmation bias there, right?
Yeah,
These growth investors, they show the growth and they say, and then there's a debate. Are you paying a lot of money for that growth because you're not making money? So you're trying to say, okay, well, if we stopped investing in growth, then we're going to make this much money. And for a flash in 2020, everything's super profitable. Everyone's home, everyone's on Zoom. The ease of sales and the need to hire new salesmen is different, and saleswomen, because everyone is on their computer, everyone is used to the Zoom calls. It's not as intensive. So their margins are showing potentially even better than expected profitability.
definitely. Yeah. Importantly, the backlog was there, backlog of contracts in place and something that's been implemented. And by the time people kind of realized, how do I say it? Because of that backlog, because they didn't need to sell aggressively to continue the top line growth, it kind of misled everyone. Nobody knew what would happen if that backlog wasn't in place, right? Which you learn later on in 2022, 2023, when it became harder to grow the top line.
That's kind of like the AI thing now, where you're seeing companies maintain their revenue, but they have 1, 2, 3 year contracts, and they might
Exactly.
have a backlog. So Workday might go out and say, okay, we're going to spend 9 months building this for you. And they sign the paper, and they, it's deferred revenue, or, they're in their projections for ARR in 2027, and they'll get to work on a 2 year contract then. So there's certainly a lag there. What I've noticed from my conversations is salespeople at these major, I talk to mostly Fortune 500, but I've been trying to get in front of as many private equity backed software, smaller, lower middle market players as well, which I believe have lower moats. But when I talk to the
Hmm.
best software companies in the world, they say they're answering questions about AI. And there might be an acquisition where they roll in a homegrown product. So if you're integrated into a Fortune 500 company, likelihood is they're not going to spend $500,000 in tokens to save 250 grand a year.
Yeah.
You know, if the CFO, if that was an easy, you're guaranteed it's just as good, they'd probably do it. I mean, payback period is 2 years, but it's not worth the hassle as they're trying to focus. Oftentimes, they're a software company themselves, or maybe they're a finance banking company. They are trying to make sure that they're focused on the right things in their business. It's not worth the marginal effort. But if growth is built into the assumptions, that's when it gets sketchy. And you're saying that 4 times ARR on the debt side. So they would give 4 times more debt than
Then
they had
ARR.
in recurring revenue.
Hmm. Yeah.
What do you think the assumptions were on the end state EBITDA margins of these businesses at that point in time?
So I think 30, 40%.
Yeah, that's really high. You know, when you're looking at 80, 90% gross margins, I'm assuming it's not super unreasonable, but the biggest variable is the sales team, right?
Yeah, well, sales team and R&D, those are two biggest expenses. But if you think about it, like if when you hit the maturity, like I mean, in theory, you don't know you no longer supposedly have to invest in R&D as much, right? You're just updating stuff. You don't necessarily invest significantly more. Sales and marketing the same. SaaS is like fascinating uh, business model in general. Like everything is scientific. Like every dollar they spend in sales and marketing is based on some formula. Like CAC to LTV, etc. So they know at what point they need to shut down the investment in growth. So 30-40% might sound aggressive, but I don't think it's too far off from the reality if you assume that growth is no longer going to be 30% and you don't need as many salespeople on R&D, you know. And again, during that COVID time, like we saw how much the EBITDA improved by cutting this sales and marketing, and that also kind of gave this sense of, yeah, like, oh yeah, that's actually possible and plausible to achieve, you know.
So with AI and everyone, Monday, Workday, Salesforce, ServiceNow, but think lower middle market, so these smaller solutions
Yeah.
for enterprise in often cases, how much are they investing in modernizing their business? Because it seems like a different equation to me.
Yeah.
Before it was a cash cow that was going to be a stable cash cow and maybe yield 10% per year in their models. Now they're like, we have to spend to keep up with everyone and win potentially a bigger pie, but it's not complete. You can't be complacent in this.
Agree. And even before this apocalypse, whatever you call it, there already discussion about where we start investing in this AI solution. It was primarily the capex dollars. It doesn't come from P&L, right? They would raise money from sponsor, or they would come to the lender saying like, "Hey guys, can you give us a little more money?" And we're like, no, it's actually equity problem, not debt problem. So there are already discussions about, hey, we need to invest. After this apocalypse, I have to imagine it went like on steroids, right? Because everything's changed like suddenly. Like I don't think we even know to the extent this model have been disrupted and which one will be completely dead. So which is kind of interesting. If you look at those defaults and what's happening in the SaaS lending world with this maturity wall approaching, like people don't know what's going to happen there, right? And even though I'm like tend to be a little bit more optimistic, the idea that no one knows the fate of this SaaS companies at this moment. You know, you need at least a year to see the existing contracts rolling off, to see how many of them going to renew, to really understand where you stand, right? So yeah, it's going to be interesting.
We talked about it offline where for the best software companies in the world, potentially they're able to go to the refinance market, the
Hmm.
broadly syndicated loan market, whatever it is, easier in a year from now. But that's only because today we don't know who's going to fail. So it may be that in a year or 2 years, software spreads are actually tighter. But then you have to worry about, well, if you're investing today on that thesis, you have to worry about, okay, but the software spreads are going to be tighter for the businesses that are still have access to the debt markets because people figured out, hey,
Hmm.
we've given you a year of uncertainty and you're actually still doing well. Credit markets, Scott Goodwin from Diameter Capital made this point eloquently, more eloquently than I could say. This uncertainty is terrible
Hmm.
for credit markets.
Yes.
Equity, it's not so bad. How would you think that the uncertainty is pricing software versus the legitimate increase in the probability of default?
Yeah. I think it's primarily driven by uncertainty because seriously nobody knows. Everybody can, I mean, people have an opinion about what's going to happen to certain verticals. I have to say is there are certain verticals like CRM or some very uh, ones that very entangled with the company's operations. It's really hard to replace, and people realize that, right? uh, there are solutions that are like marketing solutions, all these crappy companies that you don't even know why they exist. They're gonna have harder problems to refinance in general. Um, how much uncertainty pushes the spread? I think it's just adds some premium, but I don't know how to quantify it, frankly. My general thesis is just as you kind of suggested, like if people know that this company is going to be out, like disappear in a year, you know how to price it. You price it at 100% interest plus, I don't know, maybe 15% on top of it. Because they don't know, they have to come up with assumptions, and then they need to compete to win that business with hoping that other competitors have similar assumptions, you know. So it's a very long way to say I have no idea, dude.
So when you're pricing debt, even if you know the business is going to be zero recoverability after the super senior lawyers,
Hmm.
small business loans, IRS, even if you know it's a zero, if it lasts 2 years at 10%, it's not going to be trading at 20 cents. There might be some uncertainty, and typically there's market dynamics that people don't quite like those, and there's not that many distressed guys sitting there,
Yeah.
but it's worth something. So the question is, how long are these loans going to stay? I would like to dovetail this back into, well, on these software companies, what do you see as what the liquidation value, recoverability of these loans were, and how do you think that's shifted since AI?
If you look what even defaults on this company were for most of the time, they were like nearly zero. These companies almost never defaulted. And even before this whole mess, it was a big question of how much is going to recover in the bankruptcy and liquidation. I don't know if there were like liquidation of SaaS companies. I can't think of many. I've seen distressed companies. I've seen they being sold. Yeah, like something that you would think uh, companies that would traditionally be worth 5 time multiple if they grow in 10-15% or something like that. When growth stops, right? If they growth is like flat, so they multiples compress to 1.5 times maybe. If um, if there is a top line compression, it start trading below 1 time ARR. Liquidation, I don't know. Like I don't even know how many companies went through liquidation scenario, frankly. And I'm not saying they haven't. I'm just saying I can't think, and I can't think there is a. What do you really get from there outside of contracts um, or some data? It's kind of hard thing to even think about it. And to be fair, if you kind of most companies that been bought by private equity funds and most companies that were financed by lenders, they weren't this crappy, easily replaceable software solutions. There were there is like two most important metrics in the SaaS lending is ARR growth and retention. When retention is below like 90%, people get nervous, and I don't think there were many deals where such deals were acquired or financed. I mean, there were certainly, but if retention is more than 97%, it just tells you that it's a very valuable software for the business. It's hard to replace. So that's kind of gonna help. To what extent? We'll see.
I think people are confused, even my subscribers that read every post, what my investment thesis is. I sort of have a collage from the value, what is the balance sheet, what assets here, maybe what is the data worth in this particular case. Software, you can sell the Dell computers, you can sell the headsets. There's not much. Very few of them have the Salesforce tower. There's not much on the balance sheet that
Hmm.
is tangible. um, the question is, if you have a Medallia, what would it trade for if it IPO'd today? If you really want recoverability, because what Blackstone is doing, refinance, have a little bit of a preferred equity or whatever it is, and they'll say, oh well, we took the 80 cents on our billion five or billion two, billion four, whatever, because this
Hmm.
company is worth 2.5 billion, right? With $200 million of EBITDA, right? So that, though, as a public markets investor, I'm like, we smell blood. That
Hmm.
thing maybe would trade 5 times EBITDA, right? So if that's the case, you're taking a 33-cent write down on them. And then the assumptions from Blackstone is, or a 40, because they had it like 70 cents, most of them.
Hmm.
um, and then I think it's worth 30 to 33 cents. If that's the case, the recoverability is lower than what Blackstone says. So they think the worst case scenario for these software defaults is a 50% write down. In software, I think that's extremely egregious, especially when you compare to public comps. And we can look at Adobe, we can look at ServiceNow, we can look at Figma and say, okay, well, Adobe's a little lower, but growth's a little lower. Figma, just printed 40% year over year. They're a little higher. We're going to say somewhere in the middle of that because that's what our public comps say. Now, I don't even think they're doing that,
Yeah.
but those are superior software companies. Medallia was bought by Thoma Bravo because it wasn't trading well in 2021, right? And they saw value in it. And if we looked at the Thoma Bravo portfolio, went back and the brand name. Oh no, Apollo's in this deal. I hear it all the time. Blackstone, Thoma Bravo, Vista. They are so smart. You think that they're going to take a zero? So it's sort of just like taking your brain and being like, well, they got a brain. I don't really need to worry about that. And some of the conversations I've had as, I love living history, what
Hmm.
people have experienced that maybe in a textbook someday, but is only 20 years ago, is this is the same thing that happened in 2008 where they knew in these CDOs, hey, listen, there's room for bad things to happen, but those guys are smart. I don't need to worry about their risk, so I'm going to
Hmm.
continue underwriting this in the mortgage division of a bank. It's also happening in ratings. The ratings agencies I've looked at it, they're smart. They went through 2008 and they learned um, why should I question if this is investment grade? That irks me a lot. And I think that sets up a lot of bad decisions and ultimately capital destruction because people are not doing the work. And people in the public markets oftentimes do shorthand works, and very few people even read the quarterlies. But I think that assumption of trust has been damaged a little bit. And then when you look at the Thoma Bravo portfolio, it's like they got Medallia, they got McAfee, they got Proofpoint that actually had troubles and might be in the category of something that would do better in 2 years because it's a cybersecurity business that seems to me to be good.
Hmm.
But the aggregate, especially the 55 billion they put towards applications, I don't think anyone would look at those companies and be like, "Ooh, this is something I have to do a week of work on in order to pass to my PM and say this is a buy," unless they're stupid cheap. How do you feel about that characterization of um, the trust being unwind and then looking at what businesses are in these private equity portfolios instead of it's Thoma backed or it's Vista
Yeah.
backed?
I think there is a lot to unpack, right? I think there is absolutely no question that if Tomo was paying 12 times for Medallia, right, being landing 3 or 4 times considered to be quite a bit the margin of safety, right? Because if not Toma, who knew better than Toma and Vista, right? It's like almost, I wouldn't compare them to Buffett, but like they know more about the value of the software company back then, at least when they were buying it, than the lender would assume, right? Like as I don't know, a VP or whoever at the private credit shop or at the bank, you're trying to make the case that Toma is completely off. Toma is 80% off on the evaluation. It sounds pretty egregious. It's like you sound a little delusional. Like looking backwards, yeah, with hindsight 2020, that was a bad call in 2021, right? That's first thing.
Over
What?
5 years. Yeah. So if I say it's 80% lower than what they paid 5 years ago,
Correct.
that's, the stock market has gone up and to the right the whole time. Like if we're talking about an underperforming asset class, I just wanted to put the time factor into that 80%.
Yeah, I'm just saying, like, if you were sitting back in 2021 when you
Yeah.
were brought this deal, your downside scenario wouldn't assume that this company gonna lose 80% of value. It sounds ridiculous, or 60%. On on the marks on Medallia, right? I don't. I don't think they look at this as liquidation per se, because 200 million of EBITDA is still sizable EBITDA. Like I don't know what's in their model. I guess in their model, they can stabilize the company. That's why they invest in, right? And if the company is growing that bottom line somehow to 200 to maybe 300 million, what multiple do you put on that if you plan to sell it? Now the question is who do you sell it to is different, but like what's the multiple there? I don't know. Wait, 5 times? So depends. I don't know what's in their projections. Their projection is the key. Okay. I don't know how much. Like I personally, the way Medallia's business sound to me, it doesn't sound very sticky, and I don't even know why they bought it in the first place. But yeah. So anyway, I don't think it's they look to liquidate it. So I wouldn't be surprised if they have it at 2 billion as a valuation. You know,
Right.
I
So
don't know
the
exactly.
recoverability there, I'm trying to use like what would the public market say of this?
Hmm.
Their cash expense, which we do know, the reported number is EBITDA that's
Hmm.
adjusted. You don't really know what's in there, but you do know that also was reported. Thoma Bravo had to put in $100 million to keep it alive for another year.
Hmm.
So in terms of free cash, cash on balance sheet, is probably down to 50 or something like that. They needed to put in $100 million, so free cash flow maybe 100. The free cash flow and the adjusted EBITDA that they gave, if it would have covered the interest expense, they wouldn't have
Yeah.
taken a zero on the equity if it was the same thing.
Hmm.
Even in a software company that doesn't have a lot of depreciation, right? The amortization is another factor on there, and then all of the add backs that they may come up with. That is probably, if you go back into 2021, what percentile of a deal do you think was considered at the time?
I don't know, man. Seriously, um, hard to tell. I mean, I'm sure people viewed it as. Uh, I don't think anyone said it's a great company. The fact that it was public gave it more legitimacy, obviously. But when they look at retention and stuff, I doubt the retention was in high 90s or something. So again, I'm sure there was a lot of faith put in Toma and the premium that they were paying and how much cushion the lenders had. Okay, that's how I can say. And I guess it kind of leads to your last question is like, did it erode the trust in sponsors and their ability um, to value? I'm pretty sure it probably did. It should, right? There is another like thing like there is. It's just very competitive business, right? You might disagree with the valuation of the sponsor, but um, you know how Charles Prince said that when the music's playing, you have to get up and dance. Remember that? People were giving him a lot of hard time afterwards for saying that because he said it on top of the bubble. But in the banking and in the private markets, that's how it is. Like if you don't participate, you're not going to get the call back, right? And usually things work out well. And I guess it was an unusual situation. That's nobody looked past 5 years, perhaps. You know, it's kind of easier for me I can just sit here and say like, oh, they were idiots. Like I don't know idiots in this business. They just misalign as incentives.
No, I do think that they were the best software investors for the age of software eats the world.
Hmm.
Now, people are probably hitting the trust of maybe they weren't. That's sort of rewriting history. They had a great decade for software. And it's like if you were a short only fund for that period of time, you did awful, right?
Hmm.
It's
Yeah.
hard to go against the current just as easy as it is to go with. But while they're going with the current, they are doing the best. Now, today, people want to say, oh, maybe they're not as smart as people thought. Maybe they're not godlike and cannot lose like people thought. But at the same time, maybe they do know better. Maybe they do know better where they let Medallia die, right? And they make the decision, ah, there's no reason to own this. So Blackstone is now sitting there with the bag. And Blackstone saying, oh, yeah, there's a reason to own this. We're not marking it down on our books that much. We
Hmm.
restructured it. My question is, who's wrong? Blackstone or Thomas? Because it only took $100 million to keep that $3 billion of equity, which turns into $60 million of fees per year, right? It would only have taken $100 million. And they made the decision knowing if they keep it alive on their book for 2 years, they
Hmm.
actually make more money as a firm than it would have been burned for client money. And I'm not suggesting that they would take out of LPs' pockets intentionally
Yeah,
just to put into theirs at a concrete level, but that is the incentive, right?
yeah.
They still decide, throw it away. We're taking the write down, we're taking the PR hit. And I think that says something.
But I think there is more to the story in the sense that it wasn't just 100 million that was required. It's how much did Blackstone and the guys put in after they took keys? I think 300 million or something like that, right?
I think they did. Blackstone has an AI push.
Yeah.
Blackstone was the lender that didn't agree to half pick it,
Hmm.
because they were asking for a while, like, hey, like, just give us some time, give us some pick. And Blackstone was the one that caused
Yeah.
this to happen
Yeah.
because they said no. To credit to them,
Yeah.
they said no. They now own the company and have restructured it. The fact they put in 300 million, I think, is a rescue plan and also potentially an endowment effect because they still own the debt because they
Yeah.
restructured
But
it.
but the point is like if Blackstone and the guys didn't put it, Tomo would need to come up with that money, right? Because you know what I mean. There is a reason why they threw the key and they went through this stuff already. I think they lost what 5.1 billion of equity already. Wrote it off, right? To recover, they probably thought it just doesn't make. Uh, Perhaps the business is worth even stabilized less than that. So what's the point throwing more money into this and having your people spend time working on this deal when you can just completely refocus it? I mean, I think that's what's calculation. They both might be right, you know?
There is a human capital expense of a rescue and turnaround story. I do a lot of that in investing. I want the
Hmm.
equity, I want the full upside. I'm not going to own the debt at
Hmm.
80 cents on the dollar for a turnaround story. But it takes a lot of effort, and I'm pretty focused when I get into that. And maybe I only have capacity for following two or three of these turnaround stories, nor do I want my entire portfolio to be that. So maybe they just wanted to pull the human capital away to focus on the proof points of the world. What I question is if that's something to come over the next year or two. So we talked about in the beginning the software wall.
Hmm.
There's a huge software wall in 2028.
Hmm.
That is the 7 year maturity of 2021. I think if that didn't exist, people would be looking at 2027 as a massive software wall, which was just 2020. What do you think about that? And then from your experience, if you can remember both questions, I'm giving you compound questions for sure. When debt gets current, so this is my viewpoint, right?
Hmm.
In public markets, you don't want to let debt get current. I believe that uh, people are going to be like, oh, yeah, the debt's going to expire or mature in 6 months. But think about how rough 2026 is. So I think they can buy
Hmm.
some time before the currency of debt gets to be a problem. How do you see that? Okay. So it's 12 months out on a refi. You're supposed to be doing the deal.
Yeah.
And what do you think the two walls, just your
Yeah.
broad views on that?
I think, like generally speaking, let's just take software out for a second. Maturity walls, from my observation, from historical, they tend to have some sort of spikes, and there is always conversation about maturity walls, and they usually disappear, especially in the sponsor-backed deals. No one enters the deal in 2020. Let's say if it's a 5 or 6 year deal, and wait until 2026 to refinance it. The way it works is they're going to acquire the company let's say 2021, 22, 23, and every time they acquire a company, they try to push the maturity. They push it by a year, by two, etc., etc. And the closer they get to the maturity, like within 2 years, I guarantee you, every conversation they have, every add-on acquisition, anything where they need the lender, they try to extend the maturity. So that's why when people say like, "Well, the maturity of 2028, maturity will come in 2028," it's not going to be there. I that's my bet that sometime in 20 from now to 2028, and you actually can see it. I actually published the post like week or a few days ago, where there is you can compare the maturity wall of December versus now, and you already see the decline of that. Now, the caveat there, it's the better deals that were refinanced, right?
Yeah.
So what's going to happen with the shadier deal? Well, my thought process is like there are just too much incentives for sponsors to keep deals alive, right, and continue generating fees. There is incentives for lenders to not write anything off, right? So there will be some sort of combination of sponsors probably going to put some more equity, or they're going to bring this mezzanine tranche into the deal and somehow refinance it. I don't think you're going to see this massive defaults because of the much nobody can refinance the deals. Now that's without software. With software, that's the kind of wrinkle because again, because of the uncertainty, that's what bothers me a lot with the software. If people knew exactly how much damage was done, I would say the same situation would happen with software. If people know how long this software company going to live, they can price the risk. If they don't know, that's where there'll be issue with refinance. Still, I think they're gonna be start kicking the can down the road. They're gonna extend by 6 months, by a year, by I don't know, a year and a half. They might not do the full refi, 7-year refi or 5-year refi. It's probably just gonna be extend, amend and extend situations. That's just my take.
I think in your view, you need exits to happen. So when there's 36,000 PE backed companies waiting for exits that are in the years of their vintage that
Yeah.
typically they would be sold and they're not being sold, the extend there, hey, we're buying this company. We want to push 2 years on the debt that it has, or maybe completely buy it out and go to market again, which I assume is less likely. That takes exits. And if you're looking at the amend and extend thing, Blackstone said no to the amend and extend when the year before they would have said yes. And in fact, they did say yes.
Yeah, but it's a one publicized deal, right? Medallia, but there are many more that are being extended, right? Which we don't know about. Like we know about stuff that blew up, but we don't know about many deals that kind of being refinanced, etc. So there is a symmetry of the information that kind of get to the media. But I have no doubt that there's going to be a lot of noise getting closer to this maturity, but I just don't buy the idea that this is going to be this massive key throwing exercise by sponsors. Because, and if people believe that's going to be the case, they better load up on those put options and start shorting the market because it's going to be bloodbath, you know. So yeah, that's just yeah.
I think that's a really good example of how we're kind of close, but the outcomes are vastly different if we have a different view on one of
Yeah.
the toggles of this equation. Generally, I think we agree on the same setups. I would think that when you're looking at the deals that do get done, maybe it's not as publicized, but I'm paying attention. The
Hmm.
proof points, the data bricks, those
Yeah.
are the better companies. Databricks, particularly in the BSL market, that company is killing it. A lot of debt. And if you move that from 27 to 29 or 28 to 2030, it looks like that maturity wall came down a lot, but it's just Databricks. The thing that I do want to say to give you credence is my followers know, they still maybe can't put me in a box. I'm not a perma bear. So I lived through as a Ute the 2010 debt wall. And I remember I was trying to learn and I was trying to understand credit markets. I was only 15 years old, 14, 15. And I was like, so you're telling me that there's how many trillions of dollars of debt that needs to be refinanced? Sounds like a lot. Okay, let's wait and see. Like I didn't really have a view. It was kind of
Yeah.
just learning,
Hmm.
trying to see what are the smart people saying. Oh, they're saying this is going to be a big issue. And it wasn't. It got refinanced. So typically when you have these walls, people are used to, okay, it's a big number, but we just get through it.
Hmm.
The thing that I think we materially differ on is the number of deals that I think by even current gen models, their business models are affected. So Aries will come out who has massive software exposure. People don't really understand how much software is in ARCC, especially as a percentage of equity. They want to
Hmm.
do total assets. I'm a stock trader that uses margin. I'm using the equity, right? Based on that, they have 60% in software. I think 50% of that is threatened by AI. Threatened by AI does not mean defaults and it does not mean zeros. But I
Yeah.
mean, in the next 3 years, I see a material chance of that business defaulting on their debt, whether it's 25, 30, whatever it is, right? So when we get to the next gen models, as we're spending $1 trillion financed by Blackstone, Apollo, Brookfield, KKR, whoever else wants to put more money to work, that data center spend has got to come out of somewhere in the services economy, or that blows up, and that is private credit. So I think it's extremely interesting, especially if you look at these insurance balance sheets and how thin the capital buffer is.
Yeah.
Are you bullish software, or are you bullish this hyperscaler neo cloud data center spend? Because it's the same balance sheet in the credit math that if one of them experiences extreme stress, you have an extreme underperforming portfolio over a 3 year period per se. So I see more defaults than you on that.
Hmm.
And I'm just curious if you could uh, tell us how you feel about AI. And then, if you're like, like, I think it's not going to affect the software. Well, what do you think about the massive numbers in the data center builds?
I do think AI gonna affect software. Uh, to what extent? It's the when people talk about AI effect on software, like there are like different angle they use. Some say, well, instead of for companies, instead of buying the software, they're just going to vibe code their own software. Like, well, like, can you imagine that happening? Like on the, I don't know, in the let's say in any sizable enterprise, that's just not gonna happen. Like seriously, like I understand that there are a lot of enthusiasts with Mac Minis sitting there and creating their own calendars, but like on the scale, it's hard because whoever created this software inside of organization, when they leave, that who's gonna support it? You're not in the business of selling. If you're not in the business of selling software, you don't necessarily want to create one. I mean, that's just my view. Okay.
I think that there's a huge difference, and I think you would agree here,
Hmm.
in something that's extremely integrated, more
Yeah.
infrastructure type,
Hmm.
part of the daily workflow, and an add-on tool, right?
Yeah. Yeah.
The
Yeah.
tools can be one-shotted by the models. Even OpenAI today, based on my conversations with OpenAI employees, they don't even use Salesforce, but they have Salesforce, right?
Hmm.
But their model will one-shot an app that uses Salesforce's infrastructure. The
Yes.
question
Yes.
becomes how much value and pricing ability does Salesforce maintain when it comes to something that is superfluous, that
Hmm.
took 1,000 hours of engineering, but today would take a solid hour, 2 hours, and is priced $75 a month per user or whatever it is.
Yeah, yeah, yeah,
That's
yeah.
gone. That is
Yeah.
absolutely gone. And what I would say is the Salesforce may lose value. It's not going bankrupt. And I agree with you. And especially if it's integrated in a Fortune 500 company.
Hmm.
The question there becomes how easy is it to sell to a new business? Do they have to discount? Does it allow a startup? Does it allow Monday to get market share just because they can undercut with AI because they can do everything Salesforce can do, similar infrastructure, and they're competing for the same deal, so they both have to price poorly while spending more in R&D. Like that's an ugly picture. But the vast majority of the middle market deals, I believe, are a simple few mouse traps, bells and whistles, can be easily one shotted. And we truly don't know where the frontier models are going to go. Potentially in the future, it's just a one stop shop.
Yeah. Yeah, I agree. I think when you if you put the entire universe of software companies on the map, I'd say the ones that are venture backed, the legacy venture backed, they're gonna die off on a bigger scale because this as soon as they stop growing as they used to grow, they just gonna stop receiving inflow of cash from VCs, and those companies burn significant money. And a lot of times it's not even sticky solutions. I think I think PE guys gonna stay a little. They're gonna be a little bit more. They're gonna outlive them a little bit, but they're probably gonna join. Quite a few of them gonna join the crowd of that software companies. Yeah. Whether it's going to lead to this massive grave and lead to blow up of the all the loans and software loans and all the PE deals. I'm not sure, man. Well, maybe I'm just hopeful it's not going to. Like maybe that's what it is. You know, we'll see. I guess that's the thing. In terms of the hyperscalers, it's a whole different conversation. It's the amount of money that's going there is just insane. It's just kind of hard to comprehend. I don't know how that's going to sustain itself and what happens if that thing stops. You know, that's a different discussion though.
I like just proposing the sort of the mental question of like, well, put that in the same picture, right?
Mm-hmm.
Do you think the hyperscaler spend is money good? Okay, that's $1 trillion. Okay, what do you
Mm-hmm.
think the depreciation is? 3 years, 5 years, 7 years? Okay, so how much money do you need? Where does that come from in the economy? Obviously, more likely the services side, right? Which is two-thirds of the $36 trillion economy or $32 trillion economy. It's a lot. But the enterprise SaaS is like 600 billion, something like that, right? So do you think it's going to eat the restaurant jobs in service industry? No. Well, there are some service accounting, legal, otherwise jobs that aren't software but could get eaten by AI. But the biggest chunk, the biggest bounty that they're probably going to take the most of, if that's money good,
Mm-hmm.
is that enterprise spend. And if you take out the Salesforce, you say they're going to live. You take out the ServiceNow, and you say they're going to live. Right? You take out the Mondays, the Figmas. Let's just say all of the software bulls in public markets. Your companies are fine. Now let's talk about the middle market PEs.
Mm-hmm.
Right? There might be $100 billion of annual revenue inside of 15 to 50, sub $100 million per year in EBITDA. Which I talk in EBITDA. I don't really like talking in EBITDA, to
Yeah,
be
yeah, yeah.
honest. But let's just say that's the middle market of software. I think there's going to be a massive amount of wreckage there. And
Fair.
that is a lot of times in these CLOs. If you look at KKR, CLO number 3, right?
Yeah, yeah,
That the structured finance of what has been a massive allocation to software because as you said, it's recurring revenue. They love that.
yeah. Mm-hmm.
If you have recurring revenue, it's easier to use leverage on it. It's not cyclical. People have been burned by the the shale boom in the 2010s, and cyclicality, debt on cyclicality. They've also gone into other recurring revenue streams, the dental practices, the pest control, a lot around the house, and a lot around medicine. It's really, really interesting to me. You said this earlier that defaults have been low. Defaults remain low in software. If you're looking at defaults today, the 2008 levels that we're at are coming from healthcare and construction. Potentially consumer is been high and still high, and software is like 2.3, 2.4%. It's nowhere. If that spikes up to 6, 7, or potentially as high as healthcare at 10%, or potentially higher than that, if you're talking about maybe not dollar numbers, but percentage of businesses, and quite frankly, where a lot of these middle market PE guys and middle market private credit guys are, what happens to those portfolios? And what happens to the insurers? And what happens to the pensions as this asset class has admittedly outperformed throughout this cycle?
Yeah.
Is it coming to an end? And do you allocate today? How would you put that in picture of somebody that is looking at a allocation? They're starting from scratch. What do you think that they should allocate to this asset class today?
Yeah, I buy your thesis and actually makes a lot of sense. I agree with a lot of stuff you said. I don't think there are a lot of allocators who are just eager to put money to software at the moment. Again, about the uncertainty, and I don't blame them. I'm sure there are very compelling pitches from companies saying that there is this overreaction and misallocation, right? But again, I just don't think that's something that LPs would be jumping in, especially in the lower middle market and the smaller companies. I think smaller funds. I think they Thomas and all these guys would be able to raise, and I think I saw the Francisco Partners raised a software fund. But in terms of the low middle market and middle market, it's going to be tougher, at least for a year, because again, it needs a year to fully understand, in my view, what's happening with SaaS companies. And those low defaults, they're going to go up. The reason they didn't go up yet because they still have the annual contract that was paid up front, and it's per gap. It's recognized slowly recognized over the year. So that's what holds them in compliance with covenants. As soon as they run off and there is no new sales, you'll see the spike. Yeah.
Yeah, I mean, I would say if you know which middle market software company is going to refinance in 3 years, buy that loan today. The problem is that the vast majority of them are going to be kaput or restructured in some manner, potentially bought up by a bending spoons type private
Yeah,
equity.
yeah. I want to say, Bend and Spoon, we have a lot of work to do to
Yeah,
save this market.
they need more money. I'm short because the valuation is egregious,
Yeah,
um, but I get the viewpoint, and to your point, hey, if you're going to allocate money to software, you think this is super opportunistic, give it to Vista, give it to Thoma Bravo.
yeah,
I would say lesser to Blackstone. I have an irk for the investorship at Blackstone. I just don't think it's legitimate. But give it to Thoma Bravo if you believe that they are going to pick more survivors than not. And I would say give it on the equity side, because
yeah,
that's where you get the multiple outcome, where if they pick a good software company, integrate AI, cut costs on SG&A, cut costs on development, start streamlining the business, it could be the 8x that some of these guys are used to, especially with a little bit of leverage. The problem is that if we're talking in aggregates, and typically the aggregates affect the willingness of the allocator to go towards it, because
hmm
they spread their bullets, right? They're not just
yeah,
going to Thoma and Vista. They're like, oh, well, this guy graduated from Duke. Let's do, $100 million in his fund. And that's like the biggest problem. And if you talk to if you took a survey of private equity, they would say the middle market, the lower middle market's the opportunity. Why is that?
Yes.
Because they're not all at Vista and Thoma Bravo. So it's like, it's a crowd. It's a crowd that's voting. Most of them are working at these lower tier, shitty private equity companies with daddy's money. Like there, I think there's going to be a massive amount of wreckage in the industry. But I also think
Mm.
that the winners are going to win, and the winners are at the end of the day going to make a lot of money. I just think that there's going to be a massive amount of wreckage, and the entire industry is going to have to go back to being like, well, and everyone's going to say that they said this, right? Well, we need to underwrite this stuff like we're going to last 7 years, and we're not just doing deals because, oh, we can get this done. Oh, this IRR is going to be fine. Our Excel spreadsheet says this. We need to start pricing in the probability of default like credit is supposed to, right? We got
Yeah,
to.
I actually, there are two things to add there. Like first, I think there's generalist funds that added software as a strategy. They're gonna have the hardest time to raise in money because you need to be a specialist. That's where you're gonna have a edge. There is a smaller middle market company, middle market sponsors that focus on software specifically. And if you think about it, their thesis is Toma is not going to go out and buy smaller companies. It's not moving needle for them, but they can buy some smaller platform, make bunch of add-ons, and then sell it to Toma. That's a strategy. In terms of the loans, I think, and I was saying that like recently, 7-year loan to SaaS businesses should not exist. Like it should be maybe 3 years. 5 years is what's been like historically. The even that is 2 years too long. Because 5 years ago there wasn't even ChatGPT. And we in a completely different world now. So that's my yeah
And
that's my
do you think
thought.
the pace of change is decelerating, or do you think it's accelerating? Right. So the
Yeah,
certainty,
exactly. Exactly. I don't
even
think
if you're
anybody
getting
says it
10,
decelerating.
even if you're getting 10% per year, and I love the unitranche thing you said, because they all say it's first lien, senior secured, and it's like there's no mezzanine. So
Yes.
I'm looking for the second lien, and I can't find the second lien.
That's actually a big change that happened over the last decade or so, because that the leverage went up for senior loans and mezzanine disappeared. And that's one of the reasons why you see the discussions about there are fewer, um, the losses are higher on debt when it comes to bankruptcy. It's like duh, it is higher because you don't have mezzanine anymore. It's
No,
one
you
of
have
the
no debt cushion. You're relying
no,
on Excel model equity cushion. And I honestly get irked when private equity guys talk about equity cushion, because I'm in the public markets. In the public markets, the equity trades. If you want to ATM, you can
mhm.
ATM. In private markets with Medallia, the equity goes to zero like Thanos, right? When someone
Yeah,
wakes up that this value is not what we had on our Excel spreadsheet.
yeah. Well, if you're a lender, it's different though, because you know that Toma is going to put money first before it's not gonna just walk away at the second there is a problem. It's going to contribute money in, right? And eventually they're going to throw keys at you when there is nothing else left for them. They realize there is nothing. And it
Which
worked.
affects recoverability. But I would argue that the same incentive is at play in public markets, right? The whole market can buy it. It's not just Thoma Bravo. So
Uh,
if you are owning the debt of a business, you have the comfort that some people are going to be buying the stock if this goes down, right? So
I think it's slightly different, frankly.
the game theory of Thoma Bravo is going to defend this equity, I think, is equivalent to software investors are going to come in at 4 times EBITDA because that's deep value now. It's secondary versus primary, but then you have to, understand that they're going to ATM so they don't default.
I think public markets think very differently about the investments in general. They tend to be less sticky and they tend to move to the next investment much easier. like they cut losses and they move on. Whereas in private markets, you bought something, you plan to hold it to a very long time. You went in front of your committee and you LPs and you told them this is an amazing opportunity. You're gonna make a lot of money out of it, right? Then it start underperforming. You build nice shiny model, you present to your committee again, and you can fix things with extra injection of equity. I think it's stickier and safer to be a lender in a sponsored deal than it is in public market. On a small deal, okay, let's just assume it's similar size businesses, small businesses, right? Obviously, it's better to lend to software to Salesforce than it is to some shady middle market sponsor backed company. But there is a good thesis and that has been working for a long time in the sponsor backed finance. That sponsor presence, it is actually very, very valuable thing.
But again, you have a 20% shareholder in public markets. And we do that too, where we're looking at, okay, you know, this fund has a big stake in this. They're going to protect it. I give credence to it, but
Yeah.
I think it leads to bad decisions over time. Like, a big fund can't lose money. I'm highly kind of troubled with the idea that it's better to do direct lending for a buyout where the debt is used for the purchase than it is to lend to a high yield company of a similar size in the public markets, given the high yield company in the similar size of the public markets has covenants. They have SEC rules, right? There are higher defaults there, even though it's higher quality debt, because over time, because if you miss a payment, you're done. There's no amend and extend.
Yeah. Well, that's, I wouldn't say that I wouldn't say the high yield guys have better covenants. They don't. The direct lenders have much better covenants than even BSL. They actually have real covenants. I mean, you get it's your preference. If you say like,
There's a lot of cov light. What I would say is there's certainly more liquidity and
yeah,
there's easy access to the financial statements.
I can as a lender, I can pick up the phone and call CFO and say like, hey, what's going on in your portfolio, well, with your company? I get monthly financial statements. You don't get it into the public market. You don't have access to the to management team. You don't have access to all the shareholders. You cannot ask them if they're going to jump in and buy the stock at mass. So stock goes up and the company issues more equity and use the proceeds to pay down loan. I think that's way kind of it's if there is a preference, if you're allocator, I can see why you would say like, yeah, I rather be more liquid and go with high yield than to do this type of deals with private credit. But if we going to uh, place the structure which is more preferable to be a lender to uh, sponsor-backed company, check the covenants, who's doing better. I don't know. I don't think we'll agree on a lot of stuff there. Because even LMEs, you're not gonna see LMEs in private credit, right? They're
Why not?
very, very rare. Because LMEs, the reason why they happen, and they typically happen in the syndicated loan, which is the BSL. The reason why they happen is because you have 50 lenders there, right? And uh, the sponsor basically calls the higher those who own the majority of the debt and say like, hey, there is a clause that says the majority makes the decision. Let's just screw everyone else with three of you. That's how LMEs work. In private credit, you have five lenders at most, probably, usually one or two, and they're not gonna screw each other like that. It's just for sponsors, it's just harder to do this kind of stuff. Like if you look at the statistics, you'll be surprised how few LMEs that have taken place. The most famous is Pluralsight. That's all.
Yeah,
And it,
well, I don't think it's called an LME, but I did a piece on the Aries lies, and I
mhm,
show that they have two first lien loans. One of them is last in, first out. So
mhm.
if you do new debt and you have an agreement among lenders in order to keep the business alive, that to me is an LME of sorts. And we're talking about the recoverability probability of, you know, it is inversely correlated with defaults. As defaults go up, recoverability goes down. That is also happening at the same time as we've rushed towards unitranche and,
Mhm.
uh, you know, they've dropped down, which is an LME, some of
Mhm.
the assets. Yes, the LMEs are typically are not, if there's less players at stake, there's not going to be five versus one. Ares, Apollo, Blackstone make a co-op and screw over poor San Francisco software partners.
Mhm.
But I think that at the end of the day, you're going to see a lot of that. And one thing that I think people don't really consider is like when push comes to shove, equity and credit are not on the same
Yeah.
side.
Yeah, yeah, of course, of course. When it comes to, in the end of the day, somebody gonna pull the rug. There is no question about it. What my point is, it's much more collaborative, and you're much closer to the borrower, and you have much more control as a direct lender or private credit guy than you are on a syndicated loan or the high yield. That's the point, you know.
But you see that a lot when it comes to Southwest debt or, Spirit Airlines or whatever. It happens in public markets too, where the senior secured is fighting the subordinates, fighting the equity.
Yeah,
Um,
and
to
those
me,
when
it's
yeah, it happens in a public market, like for instance in a high yield bond market, like when there is like big holders of debt, they can get together and they can get something done. But usually, if you're high yield investor, like that's what you typically that's your mandate. You don't really want to go into all these fights. You just sell the bond and you move on. You know?
yes. What I'm talking about is in the tail event, right?
Okay.
So after 2008, you have
Hmm.
Caesars or whatever that's going through it. That's when you see it. And when I say seeing it a lot, I mean in high stakes restructuring. Not typically,
Hmm.
there's typically not very many defaults. But if defaults spike up, the lawyers are going to get paid for sure.
Oh, of
And
course. Yeah.
yeah, like the lawyers from 2008 got paid for 10 years. They were still winding down some of those stuffs. And I was talking to a guy on that bought Bear Stearns CDS. He bought AIG CDS. He didn't get paid anything, zero. Okay. He got it right, and then they're in court,
Who was
and
his counterparty?
I don't know. I don't know.
Okay.
I don't know, but technically AIG didn't default. Bear Stearns got bought out for
Oh,
like a
I see, I see,
dollar.
I see.
So there is the legal aspect of it,
Yeah.
and it's sketchy, and I think it happens all at once, right? So the prisoner dilemma type equation, you're going to cooperate with equity and debt.
Hmm.
You're going to cooperate with equity and debt. It's like duck duck goose though, and then and that's going to happen. And quite frankly, the Apollos of the world are probably going to win because
Yeah.
they got the relationships, and all of a sudden you can't get Wendell or whatever, Latham. You can't get them because it would be a conflict of interest. So you have to get these like boutique law firms that just simply do not have the resources to go, AWOL on these cases. So that's another reason. If, as much as I hate giving credibility to Apollo because it's Apollo or Aries because it's Aries, I hate it. I think the brand names when it comes to allocations, it's stupid. However, that's where it does benefit you a lot. If you're not betting on the talent, you are betting on the lawyers, which is talent of some sort.
But it's also fair to say that the reason why Apollo is that big is because they know what they were doing, right?
They're also
That's the
sharks.
they sure like yeah, I like you know that CERTA deal. Like, have you heard of that
Yes.
CERTA? Like one of the most mind blown thing to me was when I was reading about the deal is that Apollo and Angelo Gordon was screwed by Invesco, Credit Suisse, and other guys. I'm like, how did that happen? I thought I was misreading this stuff. It's funny.
Apollo can take the L every once in a while,
Yeah,
right?
they
They
should.
take they take enough wins. If I'm just really curious. If there wasn't a financial incentive, first of all, you might think, hey, this guy lose his girl to private credit? Like, why is he so obsessed with this? And no, of course not. It was for another reason. But this obsession with the brand names, I think, is it has some amount of value, but then you have to understand that they're allocating hundreds of billions of dollars per year. And the
Hmm.
types of people that get into these deals with Apollo are like, oh, Apollo's in the deal. We're not going to lose. Apollo's going to
Yeah.
flip on you. Like, push comes to shove. Apollo is going to rug you and take theirs. I do think there's value. I do think they're smart. I think they're slightly evil.
Yeah, yeah,
Slightly.
I agree. I have love-hate relationship with them. Like, I think they're smart, but I also hate how they gaslight people. Like, I don't like reading their presentations. It's like, dude,
Oh,
they don't
tough.
respect my intelligence at all. They're
Yeah.
just saying stuff that makes no sense. Like, what are you talking about?
I think Rowan is smart. I think Zito is smart. I think they got, their economists they put out there. I think they get
Yes.
memos that are intelligent. Blackstone, on the other hand, I think is like a political organization. You know, it's really strange that the way they come out and they're like, it's just like so buttoned up. It's like it's so stiff too. You see Barry Zito, and I'm like, I'm gonna trust that guy with my money because he doesn't watch his tongue so
Yes.
closely
Yes.
that
Yes.
I think he might be a politician. Like Barry Zito, you can manage money. I mean, I'll manage my money, but
Hmm.
I'm giving permission for you to manage money as much of control as I have. I would
Yeah.
never, if I had any choice in the world, allow John Gray to manage money. I just don't think that he has an investor bone in his brain. I think he has a
Hey,
story mode. I think he can tell a good narrative. The idea that they're an AI company now, I think
but
is
have you seen the cringy holiday video though?
yes.
They do
Well,
that. It's worth it. It's worth something.
I know. On the other hand, you have Aries that I do think is smart. I listened to Aaron the lawyer that covered Stormy Daniels, Michael Avenatti or whatever. So Michael Avenatti of
Yes.
Aries,
Hmm.
I think he's smart, but I just think that this stuff is so not stress tested. Just because you've been around
Yes.
for 25
Yeah.
years doesn't mean the standards have dropped off and you didn't rush into software and you don't have more leverage than peers. So I'm just kind of being a little bit nuanced. And I said in another podcast, I think Blue Owl is the most underrated. And the stock is showing that. I don't know if the stock is a buy because reputation really matters, um, especially for an allocator. But, you know, these guys are allocating so much money, even if they have
Yes.
5,000 credit professionals, it's really hard to be super alpha, like have much better allocation and underwriting compared to peers. I do think the lawyer thing it's easy to maintain that. You're paying them $2 billion a year. Like that is a huge maintainable edge. But as this scale of this asset class from leverage loans, as we started in the banking system, where people kind of knew the companies, there was a lot of community banks, to what is now referred to as direct lending.
Yeah.
The amount of money that's gone in there has depleted the alpha as if it's all one giant ETF, and you have to feel good about broadly private credit unless you're going to a $10 billion fund.
But you have to admit though, it's a ATF that's been technically delivering pretty good result. Like,
For sure, for sure.
yeah.
But
So for me, what I start hearing, I'm not sure if you saw like in interviews, people were saying like, well, they're going to be the difference in going forward. They're going to be difference in returns based on the managers, right? And to me, it basically sounds like, okay, the time when every idiot was making money is over. And technically, there shouldn't be that time in general, but seems like it has been, right?
It has
So
been in public markets too, by the way. It's what
yeah,
happens when the Federal Reserve just jams every crisis, and all of a sudden, the more risk you take, the better
mhm,
you are, unless you literally cross, the threshold. And
yeah,
the threshold of a risk has moved so far right, everywhere because of the amount of free money in the system. But it's the world we live in. And I will say that I've heard every year of my investing career, it's a stock picker's market. Like it's it's time for a discrepancy in allocators,
right,
and the vast majority of times it's really not. It's really not. And the pod shops have all gone to this model where it's also kind of like an ETF, trading
hmm,
monkey, um, the multi strategy instead of the single manager where there could be more discrepancy. I would push back on people that say, I don't push back on saying that the time of everyone making money is over. I
hmm,
think this asset class is equity like. It is an early stage asset class. It is not a late stage asset class, especially if you're thinking about 5 year to 7 year allocations. There's going to be a lot of money made though.
yeah,
There's no bad loans, there's no bad bonds, there's just bad prices. I think the prices are really bad. It's going to take a lot of agility. And going back to your point, there's no insider trading rules. I can call up the CFO, I can get the answers I need. That's great. But when you're doing a dental practice roll up and you have to go and talk to the CFO of a dental practice, and then you have to ask him for the individual contracts for these $1 million dentists, how long are they staying on? Oh, when did you upgrade your tools? People don't want to do that. People don't want to do the work to begin with. The amount
hmm,
of work that's going to be need to be done if defaults really spike is a lot. So the people that do it, of course, will make a lot of money. And the people that are allocating 100 billion dollars a year, they might find pockets to put 10, 15, or $5 billion to work. And that might be a great deal. But you're just not agile enough. So if you're talking about which allocators are going to outperform, I would say one, the ones that are talking about the problems today, not that are going to tell you in a year from now or 2 years from now how they were saying this the whole time. If they have a legitimate understanding of the risk, even if it's understated, if it's not hedged all which directions, if they have that today, they manage under $50 billion. I think once you go past 50 across all funds, it's really hard to be laser focused and strategic and are opportunistic, not the strategic, opportunistic, distressed buyers of first resort, but the ones that are truly sitting there for prices that lead to IRRs of 20, 25% and get the equity like returns. Because again, I think that this is an equity like asset class.
yeah. I don't even think 50. I should think it should be a little lower than 50 billion.
10, 20, it gets better.
Yeah,
Yeah.
because at 50 you have kind of already pressed to make a lot of deals. You have to you have to allocate that. You can't just sit on that, right? And it's not like you'll see that distressed dead guys. They struggled for a long time, for a decade,
Oh, for
partially
sure. There's
because
no
of direct
distress.
lenders. Yeah,
When
partially because direct lenders basically they negotiate the deal before things get distressed, you know, and you'll see them kind of complaining about it a lot too. Anyway,
someday, we got Leopold out. Maybe we get a private credit fund out. Hopefully, it's Cliffwater.
Cliff Ward is I'm still trying to understand. I mean, I every time I wanna understand what they do, I start reading and I just give up because it sounds like it's just fund of fund. What is that? I don't get it.
It's an ETF for private credit. They have a
Okay,
third of their sleeve in CLO equity. They say it's
Oh,
all
good luck to them.
90. So they have to buy into deals, which is
Hmm.
an interesting point I want to get your view on. They buy the CLO equity. It
Hmm.
works during a bull market, and it
Good.
allows them access and co-invest. They have like 20 credit professionals, 4 portfolio managers for $35 billion, way less than Apollo, way less than Blackstone, because they're not underwriting.
Yes,
They will
co-investing.
come out with marketing materials on fact sheets. I've gone through 4,100 loans. I've spent a significant amount of time on Cliffwater. If you're confused by what they say, you're not alone. It's because it's nonsensical.
Yeah, I'm not confused. I just lose the temper, and I'm like, ah, okay, whatever, next time. And I get to that point again, and I again. Same with Hamilton Lane. I'm like saying, I just I don't want to figure those out. So in terms of the co-invest, um, I think it was a great model where you basically come in and you don't need to have your own uh, workforce. You basically rely on your GPs to do all the work, and you put money to work without sweating too much. That's how I see it.
Yeah, but I would talk about the selection bias. So we're talking about software selection bias.
Hmm.
And hey, what types of deals are getting done? What types of deals is Blackstone, Golub, Bearings, Apollo, Ares? What are they sharing with you? Is it their best deal? No, they probably want to take that all themselves. So there is that equation. I
Yeah.
think that you can always be a liquidity provider in small size. When you creep up to $55 billion of assets total, like Cliffwater,
Yeah.
and I've done a lot of work on what they actually do in terms of the RIA space in order to convince people they're diversified, it's all first lien, it's all secured, lower defaults than peers, better performance than peers. Those talking points, it's fugazi. It's total fugazi.
Yeah.
So that's where it gets different. I don't think that inherently spreading your bullets, getting into deals with smart people is smart, but they're not checking that work
Yeah.
significantly.
I would be one thing I would say though. I mean, you're right. If it's a great deal, why would somebody share with them? On the other hand, the way it works typically in this two-side relationship, clearly there is benefit for uh, Apollos and all whoever works with them to have them in the deal. And if it's two-side relationship, eventually you have to give them good deals, right? It's like having a relationship with a sponsor. They will first time they'll give you like shitty deal to work on, but then a lot of times you'll be like, well, okay, I'll do this for you for this hater deal, but you gotta bring me a good deal next time. So it's like it's probably a mix of two. Yeah, so it's not just
I
crap. That's what I want to say.
I think that sort of hazing approach of underwriting, it's why people say you want to bet on the underwriters.
Hmm.
Cliffwater still clips a 1% fee that they take after the fees that other people take on the underwriting
So they
OID,
found a fund basically,
but an expensive fund to fund.
expensive fund
1%,
of fund. Okay.
right? For what they do to take 1% is crazy.
Hmm. Hey, listen, are you capitalist or not? They found niche, they made money.
Selling to
Good for them.
willing buyers at the prevailing
Yeah,
market
yeah,
price.
yeah, yes, exactly. That's how I can see. Yeah.
The On the Cliffwater, one thing that they get from Cliffwater is they buy the CLO equity. So if you're Golub, you want to give them
Hmm.
good deals.
Here we
It's like,
go.
okay, but we need somebody to take the equity out of the CLO, which we talked about on last episode with Rod Dubitsky a lot. If people want to watch that after this, if this is their first video,
Hmm.
in order to complete a CLO, you need a buyer of CLO equity.
Correct.
That is the hardest to get enough demand for. Everything else is institutionalized, investment grade. Even if it only has a 10% equity cushion, people would rather buy this, even if this pays more, right?
Hmm.
Like way more. Obviously it pays more, but I'm talking about 14% residual or 8.5% here. This is investment grade. So because Cliffwater eats $10 billion of CLO equity, is the largest CLO equity buyer in the world, I believe. There are some setup funds around this that will do great in every bull market and then go extinct in every bear market. Um, because of that, maybe they get access to good deals.
Yes.
But think about that trade off because they're claiming that it's 96% first lien.
Hmm.
Okay, but CLO equity is first loss, right? We can talk about the unitranche and all of that, but 1/3 could be wiped. And if you look at the pricing of CLO equity, Cliffwater wouldn't tell you this. It's down 15 or 20% on the year. It's one of the worst years in CLO equity. There's
Yeah,
really legitimately no marginal buyer there
I think they lost 15%. The silver equity lost 15% this year or last year. It
so
didn't do
far. Yeah.
well. But what's interesting with silver equity, and I just listened to a podcast about it. The reason why they're underperforming this year, it's not because there are losses, but because the margin compression. I'm like, oh, it's interesting. Because you would think that they're losing money or there are defaults on the loans, but that's not the case.
So you're talking about the residual just isn't there.
Well, I'm talking about like, so the way silver equity makes money is basically they have this tranches of notes above them, right? And each tranche has loans, right? And when those loans being replaced with lower yielding loans, after fees and after paying to note holders, there is less money left to CLO equity guys because that's what they typically get. They get whatever left over after paying off everyone. So the losses came from primarily from the margin compression and not from defaults or write-offs of the loans.
So when KKR takes their Medallia loan outside, it was yielding originally it was yielding 12% or whatever, and they replace it. Okay, we need a good loan in there. Where do they put the bad loan? The BDCs. Then they take the good loan, and they you're saying the margin is compressed, even though it's a safer.
Yes, because of the competition, because of the compare like Medallia had what was the initial rate, six something or whatever, right? On SOFR plus six. I don't remember the pricing, but
I think it was like five.
maybe five, whatever. But that pricing has compressed for newer loans. Maybe now it's they improved, but uh,
Well, they
just
they restructured and then it became seven. But the original I think was five in 2021, something like that.
the point is like because if initial CLO was based of like average yield was I don't know SOFR plus 550. Now they because of replacement they put loan as SOFR plus five. Suddenly there is less of the spread to get to the equity side of the equity part of the CLO. That's the point.
Yeah, I would say if we're down 15% on that, defaults are at 2008 levels. You keep defaults here. The replacement is a very interesting point that it would take 15 minutes
Hmm.
to talk about. But essentially, they will shuffle the deck. Everyone thinks it's, everyone in the industry thinks it's fine. I have a huge problem with it because it ends up in the BDCs oftentimes as I'm
Hmm.
tracking it through the footnotes. You can read the vanishing footnote on that I came out with on Substack. If defaults stay at this level, those CLO equities are going to get eaten into the mezzanine. Mezzanine are going to be forced downgrades like 2008. And that's really primarily what's on insurers' balance sheet, especially the PE backed insurers are loaded up on triple B, mezzanine CLO slices, tranches. If we're down 15% just on compression, I think that in there's probably some sort of pricing of the probability of default. People are just sketched out by it. They don't want to buy CLO equity. But legitimately, that could be a zero. It's happened plenty of times before. Even mezzanine debt has become a zero. Just to bring this back to Cliffwater, to bring this back to a lot of BDCs that have the CLO equity, because there has to be a willing buyer at the prevailing market price, even if they don't really know what they're buying. You take that down 15%, if you're allocating to Cliffwater today, you have $1.5 billion of phantom value. Before we consider anything else, before we look at their 4,100 loans, that is already the premium you're paying when you could buy, just give your money to, I don't like Blackstone, but just give your money to Blackstone. They underwrite 15% of their loans. Golub, another 15, 20%. Like they don't do the work. The huge, huge hatred for Cliffwater and the Nesbits. Even if they have a portfolio manager, Hungarian with my last name, Nemet. And I just want to
Is
be like, you're doing.
Nemet is not Hungarian, is it?
It means he who does not speak in Hungarian. So that means the German.
Okay.
He does not speak our language in the
Okay.
Austrian-Hungarian Empire. But yeah, so whatever her name is, Laura Nemeth, very disappointed in you. I've Americanized it, and my family says Nemeth, but
Oh, it's
I
Nemeth.
yeah, well, I just go by Nemeth. But if it's Nemeth or Nemeth, that's fine. I believe the original is Nemeth. And if I say it like that, it sounds angrier because those types of languages typically are. So, and I got to differentiate from my name because I'm just so appalled that there could be a Nemeth on the portfolio management of that company. Long way to have an outro. I really appreciate you coming on. Obviously, we go back and forth sometimes debating.
Yeah. I'd say you're the one person I kind of respectfully disagree with. There are certain people I disagree with quite disrespectfully, but like we're not far off on our takes. I think where we kind of differ is the way it all leads. But hey, nobody knows, right? I think you
Yeah,
have a compelling argument. Like it's hard to argue. Maybe I'm just hopeful that things are not as bad as you think it's gonna be, but we'll see. Time will tell.
I agree. We're not that far off. I just feel like it's kind of like the lower bound,
Hmm.
how bond prices move on 25 basis points change
Yeah.
when it's at zero. The lower bound for people that forgot what that was, or are never picked it up, never needed to, just bought stocks because they went up. Um,
I think it's.
because
I'll just say this. Like you know how Munger was saying to Buffett, "You're smart, but I'm right." That's how. That's what I want to end this with.
yeah, no, very little difference can make all the world in outcomes. And I think that we're both watching it, and I find it tremendously useful to follow you and to see what you're
Likewise.
saying and be able to test my theses, because first of all, you cover everything. I know the capital allocators follow you because I get your stuff from them. I'm like, oh, that's interesting. Let me read that. So everyone should subscribe to Debt Serious.
Thanks.
It certainly punches way above its weight in the credit world. It was awesome to have you on. Potentially, we can do it again sometime.